Max, Nicholas, we are here to talk about our interview with Alex Pfyffer and Ross Porter. Alex and Ross started as searchers, then evolved into independent sponsors, and have now raised a private equity fund. So quite a trajectory here. Max, what grabbed you about their story?
Yeah, it was a great episode. You guys did a great job, and they were very, very interesting. Alex and Ross, they talked a lot about different platforms that they have and different steps along their sort of searcher, sponsor, fund path. But what struck me was that they found a really great partner or operator, founder, partner in Paul Maiori in their Maicom platform. So, we often see deals where the founder's rolling equity into the deal and staying on. So what does that mean? In this case, they got, either lucky or they did a great job finding an excellent partner in Paul, who brought very complementary skills to theirs. He was a very strong operator, very good at managing customers and staff. His strengths may have been some of the weaknesses of the sponsor. And then the sponsors brought M&A experience, finance experience, growth, execution experience. So very complementary. Oftentimes you hear horror stories, and we've seen horror stories about founders who are rolling equity into a deal. So something, for a sponsor to be paying very close attention to during diligence. Can you work with this person? Is it going to be a good relationship going forward? And in their case, it was, and they had some excellent success as a team.
Well, you can hear their enthusiasm and respect for Paul. They really seem to feel that they got lucky in their first deal, that their founder was such a capable guy and such a great partner to them. He was a founder who had built a $45 million, essentially project-based business. So this was not, I said they started as searchers. That's a pretty big business to buy as first-time searchers. And it probably says something about the founder that he was, he built a $45 million business. Nicholas, what did you think? What struck you?
I often advocate the independent sponsor model as more autonomous as it comes to lifestyle, and also more flexible as it comes to economic terms for a sponsor. And so I often say it's actually growing at the expense of the private equity model or the fund model because it's better. I think we had a really robust discussion here with Alex and Ross about the pros and cons of being a sponsor versus raising a fund. And, you guys were really successful sponsors. You had 6 platforms. Why did you raise a fund? You're kind of acing it. You have 6 different streams of management fees and already building a team and so forth. And I think they gave really good answers to this. And which is better, I think, comes down to taste. And I don't think there is a hard answer on the sponsor model being better than the fund model. I think one thing that is still unclear to me is, and maybe this is the main driver for which model is better, which model enables you to deploy the most capital. Because if you're in the money management game, it tends to come down to AUM. The more money you have to deploy, the more your upside can be, right, in absolute terms. And I think they would argue that the fund model enables them to focus not on fundraising on a deal-by-deal basis, but on deploying capital into larger platforms. And while it's true that there is no theoretical limit to how much money an independent sponsor can deploy, I think they are probably right in that the fund model just gives you more to play with or lends itself towards that. So that was, for me, a really important discussion.
I thought one of their reasons for doing a fund, you're kind of talking about the financial reasons, but they had this qualitative reason, this internally focused reason of they wanted to be able to provide more of a career path to their employees. And a fund enabled them, they felt that a fund would enable them to do that better than identifying or continuing with the independent sponsor model. I thought that was a pretty interesting reason that we haven't come across from others to do that. I was actually also, Nicholas, you're focusing on their, that side of their evolution from independent sponsor to private equity. I was, of course, just as interested in their evolution on the other side, from searcher to independent sponsor, coming from my acquiring minds orientation. And I think a lot of searchers will be fascinated by that arc because they did. They started as searchers, went out to look for a small business to buy, ended up buying quite a large $45 million revenue small business for first-time searchers. But it wasn't even necessarily in their grand design to become sponsors. It was actually a pretty natural evolution. Right. An opportunity comes across their desk. They feel like it's too good to pass up, and they really want to buy this business, but don't have the bandwidth because they're focused on their primary acquisition on their platform. And it prompts a discussion. It prompts a really kind of reassessing their model. And that's was kind of the inflection point, I think they called it, that led them into being independent sponsors. It was very opportunistic, and it was kind of something found them. They followed it, and that forced an evolution into the independent sponsor model. So pretty interesting to see that evolution. But just the entire trajectory from first-time searchers all the way through now to having raised a $220 million fund. Quite a trajectory, and just the kind of the power of choosing ETA as a career, I guess, where this can take you.
Yes, very fascinating, and I wonder what's next on that trajectory. I mean, in the far future, they just started a big fund, but exactly, like, what does their life and career look like long term?
Well, and they mentioned that their investors have stuck with them. I mean, not surprising when you deliver alpha, as a searcher and a sponsor, that those investors stick with you. Obviously, you need more investors, and they mentioned some institutional investors that they got on board with the fund. A great story.
Well, let's get to it, guys. This is episode 3, Meeting of the Minds, with Ross Porter and Alex Pfyffer of Heritage Holding. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Alex Pfyffer and Ross Porter are the two founders of Heritage Holdings. They started as searchers, they evolved into the independent sponsor model, and most recently have raised a $220 million private equity fund. They met at HBS and went on to acquire 7 platforms as sponsors. They've exited 5 of those platforms with an overall 6.6x MOIC gross return. The best exit achieved a 16x gross MOIC. It was this track record that enabled them to raise that fund, and today we're going to hear the backstory, their evolution from searcher to independent sponsor to now private equity. And we're going to unpack one of their platforms. Guys, welcome to Meeting of the Minds.
Thanks, Will, for having us. Thanks, Nicholas. Good to talk to you guys again. I'll correct you very slightly, Will. We are Heritage Holding, so singular. And that was pretty intentional because when we started, our goal was to acquire one business and to run it. So when we were ideating different names with one of our mentors, Jim Sharp, he discouraged us from using Heritage Holdings and said, you guys are going to buy one company, focus on that, be Heritage Holding. So slight correction there in terms of our name, but it's great to be here.
And Alex, you didn't add the S after you did, in fact, start accumulating more than one business?
We stayed the course with our name. It feels that we had built all the collateral, built a brand identity, and that mistake does happen once in a while of people calling us Heritage Holdings. There's actually a European firm called Heritage Holdings that is a kind of a club deal allocator based in Italy. So it's too late to change the name now.
It's a nod to your roots as searchers. So perfect segue there, exactly. Guys. Let's hear how you started as searchers. Of course, Jim Sharp, well-known academic. Jim's at, where's Jim? At HBS?
He's at HBS. Yeah, he's an entrepreneur in residence, faculty member, big mentor of ours for many years. It started with him discouraging us from getting into the field. I remember our first meeting with him. went something like, what makes you guys think that you can run a business? Have you ever fired anyone? My answer to that was, of course, no. I had one intern once before business school, and so I wasn't a great manager then at all. So that's sort of how it started. Ross and I were in the same section at HBS, and we really got along on a personal level. Played on the soccer team together, and I think we quickly realized how different we were in terms of our professional experiences and backgrounds. I grew up in Switzerland, came to the US for college. I worked in investment banking after college, and worked in sales. Ross's background was pretty polar opposite to that. Ross, I'll let you introduce yourself.
Yeah, I grew up in California. I did engineering at Stanford, so I studied mechanical engineering, did grad school out there. Really knew nothing about finance or the private equity world, even post-graduation. And worked in Silicon Valley as an engineer for a few years. I started a small business, so I was running an e-commerce business selling hearing aids for 3 or 4 years before business school. And that gave me some passion to entrepreneurship and running businesses. And fortunately, kind of got into HBS, met Alex, and when we were talking initially, we didn't really see this path, but we both wanted to be entrepreneurs, wanted to build something. And, through the help of Jim Sharp, Rick and Royce at HBS, we really got exposed to the search fund model. And pretty quickly after getting exposed, we just love the risk reward profile of going out and buying a business that's already successful and running. And, mutually saw that our backgrounds were really good fits, right? Me on the operational side of, working on these businesses and improving them, and Alex a lot on the kind of finance, sales, kind of growth side of the business, which all these businesses really need.
Well, you guys knocked it out of the park as searchers. Let's hear that story. And then, of course, really want to understand the evolution from searcher to independent sponsor. But let's hear the story of this first acquisition.
We graduated in May of 2015 from business school. And of course, my expectation was that we'd find a company in 2 months, grow it by 10 times in 2 years, and make a 100x. Of course, it didn't quite happen that way. It was a pretty grueling search process. We had some failed LOIs like everyone does, and we ended up closing on Maicom, our first platform, exactly 18 months after we started our search, which was bang on average. So we were attracted by the business because it was serving the telecom sector, and there were a lot of investment going into critical facilities, network sites, and data centers, and that was a big demand driver for that first business. We lived essentially in North Andover, Massachusetts, for the better part of 4.5 years, and I think what made this investment a clear success was our partnership with Paul Mayuri, who is the founder of Maicom. Paul is an amazing guy. He started as an electrician in Boston, and then decided that he could run a business himself and build what was a sizable search fund business in terms of its revenue being around $45 million, and like many small businesses, it lacked a lot of operating systems because Paul was overconsumed with his projects on a day in, day out basis. And Paul saw value with Ross and I coming in and helping take away some of the headaches. There were a lot of functions that he had to do as a small business owner, but that he wasn't a fan of. We see that as a common trait of many business owners, actually, and those functions vary. In Paul's case, he wasn't particularly interested in doing all the accounting, finance, HR, and kind of back office work. He wasn't particularly interested in knocking on doors to find new customers. He was perfectly happy with his existing customer base. And so we saw a pretty natural fit for Ross and I. Ross coming in and adding technology and systems to what was the central office in North Andover, and myself chasing growth by signing up some of those large telecom customers and looking for add-on acquisitions. We we grew that business to about $140 million in revenue when we exited it. And half of that growth was organic by getting MSAs in place with some of the largest telecommunication firms you've heard of, the AT&Ts, the Verizons, the T-Mobiles of the world, up into Canada as well with the Shaws and Rogers of the world. The other half of the growth was through acquisition. We realized that there were other small businesses that were serving a similar customer base that also had some customer concentration, and we felt that we could integrate them into Maicom pretty well once the systems and tools were well set up in the back office by Ross. Ross, what would you add to that story?
Ross, before you hop in, let me get a couple questions in here. So it was a $45 million business when you bought it?
Yeah, 45 million. I'd say there's a few hairy parts of the deal. One was project based, right? So the company would basically what they were doing is building out and then maintaining, but a lot of build out of critical infrastructure for the telecom customers. So they would put in generators, power equipment, HVAC. They build 4 walls of new buildings for expansions. These were data centers and networking facilities that all the critical infrastructure would run out of. So probably 80% of the business were these projects year to year that they would get to go upgrade and build out these facilities. And the project-based businesses are always tough, right? You never really have more than 6 months of backlog, and no real kind of truly recurring revenue there. But you usually get the same customers coming back year after year. And the second part is, it was messy. There was just big customer concentration. Majority of revenue was from one customer. It's had some union exposure as well. Some of the union employees in Boston, which we grew to be comfortable with. And so it was a bit messy. And also in the industry, it was a pretty messy industry, right? Like there's a ton of customer concentration, like Alex said. Most of these companies grow to the size that they are through the growth of one customer that's really trusting them. The nice thing about that is, with acquisition, you can get a lot of diversification, right? So our second acquisition onto Maicom, it came with MSAs with 2 or 3 other big telecom firms out there, the AT&T and Verizons of the world. They were all local, but we were able to kind of take those local contracts that this acquisition had and bring them back into Maicom to serve them nationally across the U.S., which is obviously an awesome synergy and allowed us to expand pretty fast there.
So you said it was 45 million when you bought it. You held it for about 4 years. You tripled revenue in that time period, from which half of the growth came from organic and the other half roughly from M&A. Curious if you speculate, if Paul had just continued to hold this business in those 4 years, where would revenue have gone to? Is it easy to imagine none of the M&A would have happened, but some portion of the organic growth would happen? Or was he already capped out because he didn't have the technology and processes?
It's a really hard exercise to think through. I think the tricky things, at least what he would say, and I'd love to get his take on this, but he was very stressed in the business. That was the reason why he sold. He stayed on, like he ran the business alongside us for all those years, because I think we brought back a lot of the joy and excitement that he loved in the business. So he really loved running projects, managing the team, right, the technicians, the project managers, interfacing with our current clients of what we could go build. Like he had just had so much joy walking into a facility, seeing the general scope of what needs to get done and designing and executing on how to get that accomplished. He taught us a ton about, people management, about, how to manage a business and grow with it. But he had no interest to go wine and dine Verizon to try to open up a new MSA and expand with them. He definitely had an interest in acquisitions, or, really probably felt like that was his forte there. So I think it would have kept on growing well. He's a tremendous operator and high integrity person. So I'm sure the business would continue to thrive, but probably not to the same extent. And then, the systems was a big part of it. When we came in, it was a big project-based business, and they didn't have any project software in the business, right? Like all the files were kept in this messy Dropbox structure and on people's computers. So whenever one of our customers said, "Hey, what'd you do for this project, 3 years ago? Why'd you build it like this?" If that project manager was no longer with the company, we had no access to figure out, any records of that project, right? So simple thing of putting software into the company to be able to scale up what we could do, allowed Paul to manage a bigger base of revenue because he could get insights into every project and keep building the company.
And so this is emblematic of the lower middle market, which is where you still operate today, right? You come in a founder-owned business who has kind of plateaued a little bit in terms of his personal motivation He's a little satiated, and the business is kind of at max capacity with regards to their facility or operations. If not max, at least it's starting to plateau, right? So you as a professional buyer can come in and through M&A and professionalizing the operations, this is the opportunity of the lower middle market, right? And captured in one deal.
Yeah, 100%. Yeah, I think you described that well. I think generally we see it that, business owners own the business for 20, 30 years. They're doing well, right? We're buying businesses, on average, probably $1 or $2 million in profit. So they're taking a lot of money home year to year and really successful. And I think we see a lot of the times, they don't really have that urge and push to go double the business, right? Like why work, 3 times as hard to go expand sales and can keep on growing the business if it means, a lot more work in the business and go drive it. We, of course, are totally willing to take that trade, right? We're willing to roll up our sleeves and grow these businesses and put a lot of that time and energy and effort into how do you scale the business as well as how do you do follow-on acquisition successfully to build the business through M&A.
Although I will say to have gotten to 45 million in revenue, this seller founder really pushed through a bunch of the ceilings that characterize what we just described, So he definitely had some organizational chops and ambition to get it to 45 million. I mean, that's really big for a messy lower middle market, founder run construction business.
Yeah. But Paul's awesome. Like he, just a tremendous business manager. And he taught us a ton throughout those 4 years of how to run a business and how to grow a business. And,
you mentioned that he taught you people management. Alex, how was the first time firing somebody?
It went pretty poorly, actually. I think one of the big rules about letting people go is that it should never be a surprise. And in this case, it was a big surprise to the person at the other end. And actually, those were the first words uttered by the person was, "Whoa, I was not expecting that." And so, management 101 was not well executed on my end. I will go back to Paul, and we talked a bit about his business acumen, but I think what we learned by working with Paul is the truly founder-friendly approach, which we've carried on in all our deals. Everyone talks about being founder-friendly, but I think we really try to walk the talk, and because we realize how important Paul's expertise was to this whole thing. We put Paul and other founders on a pedestal, really, and approach acquisitions with the humility of saying, hey, we'll never know your business as well as you do. You've spent decades in it. You've built it. There are reasons why the systems or processes are working a certain way. So we're going to take our time to learn it before changing anything, and we're going to learn from you, whether it's on the project management side, on the customer relations, or on the managerial aspect of hiring and firing people, right? So that approach that we learned through Paul is a big example that we use in all our deals.
Yeah, I think that's a good point, Alex. I think a big thing for us is we're not from the PE world, right? Like we got to start building this ourselves. And I think that's a great thing for this size range of business, right? We're not taking a transactional approach of, being aggressive on legal documents or being aggressive on how to structure these deals to maximize value, right? We're really just trying to find a fair deal with a great business and a good founder that we can keep on building. So we're not going back into the legal docs years later, and we're not suing founders or going crazy with any of these kind of the legal transactional part of the deals. We're really trying to find great founders we can partner with, and that's been really successful for us here.
But Alex, as you say, everyone says they're founder friendly. Every single lower middle market buyer out there will say that. So how can you prove that you are, or what are the things that you actually do that makes you best in class on being founder friendly?
I have a good example. With Paul, within 3 months, we had the working capital true up, and there was it was a hard business to define working capital because there's all these projects that were ongoing, and it's hard to define how profitable they were. And we were off probably by $300,000 or $400,000 on who should get that money, and we relented. We gave it to Paul. We liked the partnership so far. It was working really well, and it wasn't about the money at that point, right? Kind of sacrificing a few $100,000 at that stage to get somebody who really trusted us was really worthwhile for us. And he credits that actually at that point. He came back a couple of years later and made it a point to notify us that, it was a big part of him gaining trust of who we are as people, as, business people.
To add to that, I think the nice thing about having been in this business for almost 10 years now is that we have worked with about 40, 50 sellers, 29 acquisitions, some had multiple sellers. And so there are a lot of people that we can call on to provide a reference. And we often tell founders that we're looking to partner with, during the LOI stage, hey, I think it would be a good idea if you spoke to Paul or to Ari or to someone in our network that we've worked with. And we try and find from our group of sellers the ones that are best suited to that specific situation, right? Every deal is different. The seller dynamics are different in every transaction that we do. But we now have a good sample size of people who are willing to talk about their experience, the good and the bad.
Guys, tell us the end of the Maicom story after getting revenue to 140 million, how that ended, and then I want to hear how your decision of what to do next, what that looked like.
We sold Maicom to Audax Private Equity, right in Boston, where we're headquartered. We went through a sale process in which they acquired us alongside another platform that was more focused on the wireless side. Paul is still running the Maicom organization under Audax. In fact, he's running a much larger organization under Audax. I think it's a different setup than working with us. It has its pros and cons, I'm sure, but it's now a much larger business on the Maicom waveguide side, which is what Paul and us had built together.
Well, not bad to exit grow to $140 million, and then exit as first-time searchers. Not bad at all.
One more thing to add on that, Will. You asked about whether Paul would have been able to grow the business. I think so, without a doubt. He would have grown the business significantly. I think the one emphasis that we put on the growth was towards diversification of the revenue, because we knew that would make the business ultimately more valuable. I believe that Paul would have continued his growth at a fast rate, but maybe more focused on the initial few customers that Maicom had before we came in. And I think that, meeting of the minds, no pun intended with the name of your podcast, was what made the difference in terms of the Maicom growth story between Ross, Paul, and myself.
Fantastic. Yeah.
What a great pun also.
Well, we see that a lot at Minds Capital when we're evaluating a sponsor's deal. If there is customer concentration, of course, that's one of the first, if not the first, weaknesses that the sponsor will acknowledge, and then they'll present the plan for how they're going to address that concentration over time. And so the question always becomes how realistic that plan is. Sounds like you guys, you executed it well. You said the majority of revenue had been from a single customer, so over 50% concentration. That was a big bet.
Close to 85%, actually. It was a big number. We had dug in and figured out that there were about 15 different decision makers in different divisions within that large customer that didn't talk to each other necessarily. So it felt more diversified than the headline number, but still a big risk and something that we had to structure around. We had an earn-out based on keeping that customer in place for many years. And that is a feature that we often have in our deals. In fact, most of the companies we look at in our size range have some element of customer concentration. It's just part of the small business world. And we're perfectly comfortable with it. We can live with it and have had great experiences growing within the largest customers like we did with Maicom.
And some stressful experiences. I will say it's one thing seeing customer concentration on paper, but actually operating the business and living with it. Those first couple of years, I think every single phone call from Paul, we just expected him to tell us that there's some issue with that customer and the business is shutting down and everything will go bad. So it is a stressful time period to operate those types of businesses, but it's a good experience.
It's also one of the places where you really make a lot of value, right? And we looked at the deal with you guys here a few months ago. the target had a lot of customer concentration. It was the number one concern, I think, for all of us. Right. But you guys come in with a mindset saying we are thinking big here. We think they can sustain this customer, so we think it's believable. But we are planning to do a handful of acquisitions within the first couple of years maybe, and grow our way out of this customer concentration, which in this industry is intrinsic. It's just how you start a business. In this particular case, they're servicing utilities. And so you won't find a small business without customer concentration. And the beauty of adding value, getting to 6.6 gross MOIC, is if we can put together 5 of them, then yes, you have 5 entities with customer concentration, but on an aggregate basis, that's now gone, which greatly expands our valuation multiple. And so you've used that playbook from the very start with Maicom, and you're saying a lot of your platforms still have this feature, but because you're doing a multi-acquisition approach, over the course of doing 5 acquisitions within any given industry, I'm sure maybe one of those 5 will lose their big customer, but on aggregate, that works out okay because you can buy them cheaply because of this feature.
I think that's right, Niklas. And the business in question here is Valor, which is a power line repair and maintenance business headquartered in northern Texas and doing business in Texas and New Mexico. And I think it gets to the repeat nature of revenue. Of course, we would all prefer to buy companies that have 10-year locked-in contracted revenue, but that there aren't as many businesses like that to go around, and they're trading at much higher multiples typically than we would pay. And so it's really digging in and understanding how likely is that customer to come back year after year after year. And in the case of the power line repair business, if you're doing a good job, you've got a great safety rating, you're delivering on cost, quality, and timing, there's no reason to switch you out. And very similar dynamic has existed in many of our platforms, including Maicom that we discussed. As long as we're executing on the work, and there are no accidents, and that we're responsive to our customer base, it's much easier to continue to award us work quarter after quarter, year after year. And I think it's that nuance of repeat revenue versus one-time revenue, which we often try to understand within the companies that we acquire.
So after your experience with Maicom, your huge success, huge win with Maicom, you decide what is the go-forward plan going to be for you as a partnership?
So it actually started while we were operating Maicom with Paul. We came across a very interesting acquisition opportunity. It was a data center based in Philadelphia, which came through our sourcing effort for add-on acquisitions for Maicom, but did not fit the mold of the Maicom platform. It was operating data center space, selling co-location and server space to businesses, which would have complicated the message of the pure service platform that we were building with Maicom. Because that data center business had so many attractive characteristics, 96% recurring revenue, 40% plus margin, growing at a very stable rate of 4 or 5% a year. We were acquiring it for 4 times. It felt like a deal we had to do, but we did not have the bandwidth to operate it. So that was actually one of the biggest inflection points at Heritage Holding for Ross and myself, was to go into a second platform, which was not an obvious decision. We decided to move forward on it if we could find an operator that we could partner with that could grow that data center business, which was called Quonix at the time. And that's when we partnered with Adam Parker, who is still a partner today. In fact, Adam is instrumental to the managed services business, which we'll talk about in a bit, Will. But getting to that second platform, a year and 3 months after acquiring Maicom was an inflection point. Adam did super well with that platform. In 3.5 years, he grew the business 8-fold, primarily through acquisition. It was the first business we sold actually in the fall of 2021 in order to crystallize some IR, get some track record, and it was a great experience, which has led us to work with Adam again, and we hope to work with Adam for forever. So that was the transition to being more of a multi-platform independent sponsor, if you want to call it that, which we required finding the right operating partner, Adam. Once those two platforms were going well, we decided to hire a team at Heritage Holding to go into the next few platforms, which was another inflection point. And that's when we really started increasing our pace of acquisitions. Mm-hmm. And that's when we realized that if we were focused on a handful of platforms, we could still provide a lot of operational bandwidth. We could do some add-on acquisitions to create scale. And that's where we refined the Heritage Holding model of partnering with founders to professionalize their companies and reduce the key person risk.
It was the kind of opportunistic, your first independent sponsor style deal was sort of opportunistic. It came to you. You wanted to figure out a way to do it. It worked thanks to Adam Parker. And that opened your eyes to this model, and you recognize that there could be real scale here. And all the while, you're still in Maicom, or during this kind of evolution, you're still
Absolutely.
in Maicom.
Yeah.
Mm-hmm. Mm-hmm. And just, it is a big, while you discover that, wow, this can work, it's still a big shift in how you're going to spend your time, indeed your careers, co-CEOs in Maicom, shifting from really being operationally involved to a little bit more arm's length, a little bit more as investors, sponsors. How did you think about that? It's a very different profile of a professional life and a path.
It's a great question. It's something that we've probably told her with for a couple months there as we had Quonix under LOI. I think it was a really hard choice, right? We had Maicom, which was probably 10 times larger than the second business, Quonix, that we were looking at buying. It was concentrated still, right? It still felt pretty risky. We hadn't yet diversified that much or grown it that much to really prove out that Maicom was working. And like you said, we were spending full time of our time to improve Maicom, right? A ton of our efforts were in running it day to day. I think it goes a lot to our partnership, Alex and myself. I think we feed off each other in a way where Alex loves growth, loves pushing what's possible at Heritage Holding, right? Just throwing out ideas and possibilities of what we could go achieve, and maybe me as the naysayer trying to figure out what is actually achievable and we can go do. And we went back and forth a lot on it. And I think I really got opened up by what Alex was talking about of, hey, this is small, right? Like a tenth of the size, but really opens us up to be able to do multiple acquisitions. It diversifies ourselves a little bit away from maybe the single, platform concentration risk where, if Maicom had not gone well, right? Like it's not obvious that we'd be able to raise money again and go do more acquisitions. But if we had somewhat of a diversified portfolio and Maicom didn't do well, we still probably had a chance of continuing on in this career. So, I think from all that, we jumped into it. I think we generally love opportunism and taking on new opportunities as they come up and, figuring it along the way. And, Adam was a big part of it to give us confidence that, we'd have the bandwidth to go figure that out. So it's something we always debate. And we also debate like how deep into the companies we should be getting into, right? Like all these companies need a ton of bandwidth. Right, Maicom, as we described, need a lot of systems and tools and processes and salespeople and a lot of time and attention, and that's what we're always thinking through at Heritage. So we're always hiring on people that are really good on the operational part, right? So most of the employees, they're not private equity investment banker types that you'll see in most PE firms. These are a lot of people from operational roles. A lot of people at Heritage, have parents that had small businesses and they really understand what a small business looks like. Because they do not look like larger businesses out there, big corporations. They have very, very specific challenges that are true to almost all small businesses that we deal with, and it's also a big EQ part of the business that we have, right? Like how do you deal with small business owners as well as all the employees at these small businesses as they go through a pretty serious transition and in ownership. And our goal is to continue those businesses without much change and keeping all the employees happy and inside those businesses.
How has it been when you transitioned from 1 to 2 deals and later you eventually did 7 deals as a sponsor? How have the reactions been from your business partners, and in the first case at Maicom with Paul, and also your limited partners, your investors, when you start saying, hey, we're no longer full-time focused on this, or we're moving on to our next deal? How have the reactions been? Has there been any pushback at any stage as you guys have expanded your scope? Or if not, what do you think it would take to spur any resentment from them?
Yeah, it's a good question. I think most of it came from going from Maicom, the one asset, to the second platform there. Because initially we thought it would just be one platform and we'd grow it until, we sold it or did something with it. And then, pretty early on in that evolution, we found the second platform and decided to do it. Almost all investors were happy and supported. Almost all the investors in the second deal were all Maicom investors, and they were excited to keep on doing deals with us. There were a few that brought that up, that said, hey, we invested in you to focus on one deal, and maybe they didn't invest in that one, but they came back and invested later on, as we kind of proved out that we could handle multiple platforms. Paul's, again, just one of the most awesome partners we could ever imagine. So we were nervous about it, but he understood and saw the commitment and time that we were really pouring into Maicom.
But where is the break point? Where is it reasonable for outsiders to be skeptical or even resentful?
I don't have a good answer for that. I think we were running 5 platforms, and it was mostly just myself and Alex. I think we had 4 employees at Heritage at the time. And that was a lot. That's a big reason why we decided to sell a few businesses in 2021, and then also scale up our team at Heritage to do more. But I think we've been really blessed to have really good LPs, really good partners like Paul. Paul, for instance, is an LP and other platforms that we're going and buying right now. He just really supportive of what we're doing. And I think Alex and I put a lot of pressure on our plate because of all that to make sure that we aren't overextending ourselves and making sure our returns stay high, because we're so focused on concentrated portfolio.
Yeah, to add to that, I think on the LP side, we were lucky to have pretty much the same investor group across all platforms. That creates really good alignment and stops one LP from thinking, hey, any time you spend on platform 2 or 3 is time you're not spending on platform 1. So for anyone looking to do multiple platforms and an independent sponsor, I would encourage you to pick an investor base that will follow you across multiple platforms. I think that's a big point. With regards to business owners and partners, part of our value proposition to someone like Paul, or someone like Jeremy at Complete Network, which we'll talk about, is that we will be providing resources to their stretched amount of time and bandwidth, right? We think of ourselves as adding resources to focus on important but not urgent initiatives. And as long as we're contributing to that, and that takes different shapes and sizes, depending on the platform, but as long as we're adding resources and focus, we are unlikely to get a complaint. We haven't had one yet. We've managed to scale the team progressively to follow the number of acquisitions we've done. So, today we're 15 people at Heritage Holding, which is more than ever. I think we were 4 or 5 when we were running 5 platforms in 2021, and we were tapped out at that point.
That's interesting. So you distinguish between urgent and important initiatives, and you make sure to give attention to each within every platform. And where urgent are necessary, table stakes to take care of, important is where you build a goodwill and stay proactive.
I think that's right, Nicholas. And in addition to that, pretty much every founder we've worked with has their plate full with important and urgent stuff. That stuff just doesn't go away, and it feels like a constant firefight to, deal with a bookkeeper that might have quit, or a fire at a project, in a different state, right? And so there are initiatives that these founders have top of mind, but they just do not have the bandwidth to bring those forward to be done. For example, building a sales team to go after a specific end market, implementing a more robust ERP system, thinking through a new bonus structure to incentivize technicians to have to get projects done quickly or below cost. These are some of the initiatives that we've taken on and thought through with the input of the business partners we work with the business owners we work with, but we're able to fast track them.
I love that. I've never heard this framing. Of course, important, urgent, important, not urgent. This refers to the classic 2x2, where to prioritize your time matrix. Is that the Eisenhower matrix? I think it might be.
I think that's right.
Mm-hmm. And I've never, I love how your focus is the important but not urgent. I mean, I think important but not urgent versus important, urgent can also, that kind of nicely slots into working in the business versus on the business.
Completely.
I've never realized that. It's such an interesting, and so your role is the on the business, strategic, long-term, important stuff, the stuff that the operator has such a hard time devoting any resources to. That's where you see your role.
That's exactly right. There have been situations in which we've been pulled to working in the business to replace an executive or because of an immediate need. But that is not where we add the most value. But
yeah,
members of our team have gone slotted in. I'm sure we'll continue to do so. We have the ability to do that, to become an interim executive in the businesses if we need to. But most of our work is on the business. One of the hiring models we've employed, which Ross alluded to a little bit, is our heads of integration. So we are very big on employing people that have a knack for operations, have a passion for operations before investing. So not necessarily from the hedge fund or private equity world, but more from a small business background. And that individual has a really unique combination of very high IQ, but also awesome EQ. That person can come and present to the board meeting with our limited partners, but can also help a new bookkeeper navigate the new accounting systems that we rolled out, right? And someone that has that range is hard to find, and is how we're looking to build our team, is with those individuals. Those individuals are the point person for each of our platforms. They are managing seller relationships, they are managing integrations of M&A, and they are responsible for setting that list of urgent but not important but not urgent initiatives, and making sure we are keeping our sellers satisfied with our progress towards these initiatives, and that we are delivering on the promise that we made when we were entrusted with the business of people like Paul and Jeremy. It's not something we take lightly when someone sells us their baby. And so these chief integrators help us deliver on these promises.
Let's turn our attention now, guys, to a closer look at one of the platforms, and probably a lot of these themes will be made concrete. Your most recent platform before that's still outside the fund as independent sponsors is your MSP platform. Give us the high level on that, and then I'd love to kind of walk everybody through the thesis all the way through the execution and really go step by step. But high level, please, on what it is.
Sure. In March of 2023, which I'll never forget that day, because it was the week of my wedding, and Ross and I were closing that platform, and literally as I was about to get married. So it has a special place in my heart. We acquired Complete Network from a very talented founding team. Jeremy and Ben had built up Complete Network partially through acquisition of small tuck-in MSPs in Charlotte, North Carolina, and Albany, New York, using SBA debts, and had built a sturdy, growing IT MSP business focused on DM and SMB. It was kind of the angle, and we acquired a business that was doing about $2 million of EBITDA as our platform. Since then we've done 5 add-on acquisitions. Is that right, Ross? I think 5 add-on acquisitions, which include 2 more traditional IT MSP businesses like Complete Network, and 2 companies that are more focused on providing products. One is providing a cybersecurity product. The other is providing an analytics product focused on database management and administering AI tools for large data sets, essentially translating multiple data sets into a unified language. And our thesis has been to cross-sell these product sets into our IT MSP customer base, and also to gain new referral sources for traditional IT services from cybersecurity customers that were being turned away for traditional IT services, and analytics customers to our company BlueNet in Tampa, that were being referred elsewhere. And that is really coming to light, and really coming to fruition, I should say. So far we've generated about $260,000 of cross-selling, of MRR in cross-selling in that platform, which is the combination of building a sales team under the leadership of Anthony, setting up the right incentives for referrals across all the sales team, having a centralized CRM tool that tracks all the deals. And so we couldn't be happier of the progress of that platform. We are now at 9 million plus of EBITDA, with a healthy combination of organic and inorganic growth. Up from that 2 million at which we acquired the business, a little under 2 years ago. I think that pace that we see in terms of the velocity of acquisitions that we're doing at Complete Network is something that we're looking to replicate for our fund. I think that doing 3 to 4 acquisitions a year per platform is kind of the minimum pace we're looking to go at with the platforms that are in our fund one.
And so was Complete Network a deal that fell in your lap, or did you have a thesis in this space that you pursued and this was the best platform you came across?
That was my favorite kind of sourcing, a referral from a seller that we had worked with in the past. So Adam Wells, who owned Turnkey Internet, which was a data center that we bought in Albany, knew the team at Complete Network well and referred us as a potential buyer. We had been working on an IT MSP thesis for some time. In fact, after selling our data center business, Adam came back to work at Heritage Holding with us, and we jointly built that IT MSP thesis. And Complete Network was the deal of the right size with the right executives in place, which has allowed us to execute on the pace that we're executing at today. So it to answer your question, Nicholas, it kind of fell in our lap.
But you already had some knowledge about the space and had been in the adjacent data center space.
Yeah.
And so for a 2 million EBITDA platform, how much do you pay for that from a valuation perspective? And is that more or less what you've been paying for add-on acquisitions? And where do you see the valuation being now that you're at 9 million?
Yeah, we're paying between 6 and 7 times for our deals in that industry. It's tough to say that multiple number is what we'll pay across all our platforms. I think our average entry multiple across all our companies is below 5 times, and we want to keep it that way. But the revenue quality of the IT MSP space is fantastic. We're talking multi-year contracts. Vast majority of the revenue is recurring, and the companies we buy have great retention metrics. So we're perfectly happy to pay up for those types of businesses. I think that, but it's tough to say that those multiples will be paying for other platforms and add-ons across our portfolio. I think it's very industry specific.
So you're doing 6 to 7 on the entry side for smaller targets, 2 million of EBITDA or thereabouts. And now that you're at 9 million, what's the market value for multiple for a 9 million EBITDA company in this space?
That's something we try not to think too much about, Nicholas. To be honest, I think we're very focused on continuing to grow the business organically and through acquisitions. We've got 2 signed LOIs right now, which will close soon. I think we're trying not to, what is it? Count our eggs before they hatch. Is that the saying? And so we're we really want to focus on 5 years of business building.
Right.
Before.
I'm thinking on it on your behalf. And,
okay, please do. Let me know the answer.
My knowledge of the space is probably well into the double digits, right? So you're looking at a massive multiple arbitrage here, which is, of course, the game with roll-ups. Now, my next question is, you've successfully acquired a lot of companies to this platform already. At the very top, Will was introducing you, and he said that you have a 6.6 gross MOIC. The even more impressive metric is that you have a 99% IRR on your exited platforms today.
Because we have to specify that's gross, by the way.
Gross, still very impressive. And one of the reasons you have a really high IRR is because you actually have somewhat curtailed investment periods, 3 or 4 years. So you say we're focused on a 5-year build here, but in fact, if you're going to stay true to your high IRR pursuits, you probably are halfway through this, coming up on the 2-year mark. Is that how you're thinking about it?
Not really. Yeah, I'll say, a lot of that IRR and kind of short time frame was, getting wins on the board early. We saw ourselves in 2021, which we described as being overstretched a little bit, too many platforms, all of them doing well. And we saw the market in 2021 was just really high. We were not able to do any acquisitions in 2021 because, we saw a bunch of bolt-on multiples just, through the roof within data centers and telecom and everything else. And so Alex and I sat down and said, hey, with multiples where they're at, it probably makes sense to exit one or two of these platforms, get some liquidity for ourselves. Like we hadn't made much money out of Heritage at that time period. And also a track record for our investors, right? Kind of prove it to them that this is actually working. So, those 3 exits, we thought we'd only sell one, and then we got a bunch of inbound offers, and, all 3 of the companies that we thought about selling ended up closing. In general, we don't love selling businesses, right? Like it forces us to go take risk within a new industry that we don't understand well enough, right? We have to learn again, we have to build up a lot of that experience within the industry, as well as the team, right? Like it takes us a long time to build out the right team within the founders that we partner with, hiring on good finance people and people that can help to support the scale of these businesses. So we love to hold these as long as possible. And if we still have that M&A engine turning and doing well to add on companies, there's no reason to sell them. So our intent is to hold these as long as we think it's, we're adding value to them and keep building them. And that's probably why Alex is mentioning that we don't really think about what multiple we could sell it today, because I just don't think it's that relevant, right? We know that if we keep on adding EBITDA at, reasonable multiples that we're buying it at and continue to grow at 10% plus organic growth rates, of course we should keep holding this. And of course we're adding value to the platform.
I think that the acceleration of the growth rate from where we started with Complete Network to where we are today, going from a mid-single digit growth rate to a double-digit growth rate, is part of that cross-selling that we're now implementing. And I think if we can continue to operate at a double-digit growth rate and acquire EBITDA well, and have a focus in terms of our what we call the right to win for MSP Platform, I think we'll be very successful when we do decide to sell the business. It's definitely on track to go very well, Nicholas. I think the other thing to note is what Ross just mentioned about once you're in an industry and you've already validated it from a diligence standpoint, you know what to look for. There's no reason why not to do 20 deals, right? And that was part of the thought process for us raising Heritage Fund 1, is to be able to go faster and to do more deals within our platforms. Historically pre-fund, we have done an average of 4 deals per platform. The goal is to do 10 plus with this fund. And there's certainly the environment to do so. We're talking about the MSP space. There are 30,000 targets or more in the industry. There's got to be over 20 consolidators, but we're still finding great new deals every week, of companies that are not represented by bankers, with whom we can build a relationship and kind of nurture through a positive sale process, and hopefully make those sellers our partners into the growth that we're executing on at Complete.
And it's almost like a nudge back to your company name, where we thought about it as one or multiple holdings, but in fact now we're using it as a verb. You're holding companies, Heritage Holding.
I love it.
Exactly, love it too.
But that model works perhaps as a sponsor that tees it up with the investors when you go into a deal. But with a fund, with your go-forward investments, they will have a more finite or definite timeline, right?
Yeah, that's right. They have a little bit more of a timeline. We did push to extend that out, as much as we can. But be right. It's a little bit different investor base. I will say the fund is, close to 50% of the existing investors we've always had. They rolled into this fund and invested in the fund. And then we have a few more institutional investors, right, that will write a little bit bigger checks and help scale with us. And that was a big part of it. Making sure we still had that flexibility to sell the company when we thought, everything was the right time, and you maybe hold on to them a little bit longer than some of the traditional PE, should we decide to.
Let's address the fund directly, guys. So this is the next big inflection point in Heritage? How did it come about? Tell us your thinking there.
We had talked about raising a fund in early 2022 after having sold a number of platforms in 2021. And Ross and I felt that we weren't ready. We did not have the scale of the team necessary to deploy a fund. We wanted to take a bit of time to think about what to flesh out the strategy for our fund. 2021 was an extremely busy year. And so we decided to continue with the model that we knew well, which was that independent sponsor model, acquire more platforms under that model in 22 and 23, which forced us to continue to progressively expand the team. We found ourselves in late 22, early 23 thinking, now we have this great team, we need to have better goal setting for our team members. It can't just be Alex and Ross just slinging platforms here and there, and there needs to be a trajectory. And we found that this fund route presents a great career growth opportunity for our team members, and was a great way to continue to keep them and continue to help them grow in their careers and incentivize them to great results down the road. So that was a big part of the thought process, was the team. The other part was that we felt that we could, our throughput of deals was improving drastically. We felt that our time under LOI was getting shorter. The number of deals we were closing every year, with the two platforms that we still own pre-fund was the best space we had ever operated at. And so it felt like the right time. And so we went back to our existing investor base and talked them through our plan for the next 10 years, which is what, the duration of Heritage Holding Fund 1. And we nurtured some of the conversations that we had with some institutional LPs that we had gotten to know quite well over the previous year. And it became a very kind of organic evolution to the Heritage story, much like the Cornix acquisition was, which was platform number 2, much like hiring a team at Heritage Holding was. All of it felt like we were challenging ourselves the right amount, right? I was creating problems for Ross to solve, as Ross alluded to earlier, and so that was the thought process, Will and Nicholas.
So the two big reasons that I'm hearing are the retention, the ability to recruit and retain your talent, because there's a sense that you guys were successful as independent sponsors, and it's clear that you're going to continue going down that path, but it feels less perhaps certain for your employees if they're just kind of working with a couple of partners to do deals versus a fund. I got to ask, actually, before we talk about the other reasons, is that psychological or is that real? Was it just their perception that you guys doing deals was somehow less substantial than raising a proper fund?
I think it all starts with the psychology of it, right? If we have a committed fund vehicle that is lasting a number of years, that presents a lot more stability in terms of a likelihood of employment, but it's also exciting, right? Where we went from, we deployed $3 million in our first deal in 2016, right? Before the fund, we had deployed about $75 million. And now with the fund, we've got $220 million, not to change our strategy because our strategy is working. We're staying in the same lane, but it allows us to grow even faster. And I think it just creates a general sense of excitement at achieving, at growing a company alongside us. And I think everyone in our team, as far as I know, is excited about us deploying that capital well and getting into the next 5 platforms. So I think there's definitely a psychological element to it, Will, to answer your question. Whether it's real or not, unless we had stayed independent sponsors for the next 10 years, we probably will never know. But I think it's more of a psychology for young, driven individuals that really are ambitious and want to grow in their careers.
But is there a part of you that views the independent sponsor model as superior compared to a fund. I spend a lot of my time advocating for the independent sponsor model, right? And we're seeing massive growth in the space. Initially, it was because sponsors were able to pick up the small targets in the lower middle markets that funds were not yet going after. But today, I think we're actually seeing growth in the sponsor model at the expense of funds. There are low barriers of entry. Your lifestyle is more autonomous because it's only related to individual businesses, not related to being a fund manager. And on that line, you're a business owner. You identify as a business owner, not a money manager. Your timeline is shorter probably for most sponsors, or much longer if you have a permanent model. And your economics are deal by deal, so they're not diluted by, in a fund, if you do hypothetically 5 deals in a fund and one of them goes really poorly, it's going to dilute what you guys as the general partners get out in total. Versus if you did 5 deals independently as a sponsor, you would get 0 from one, but the other 4 deals would be completely undiluted, right? So both from a lifestyle perspective, flexibility perspective, economics perspective, the sponsor model is great, which is why it's growing, but you guys actually decided to depart from it.
Yeah, I'll push back on some of that. Like some of that's definitely true, and I'll address that. But I think we don't consider ourselves money managers, right? Sure, we have a fund, but the day-to-day really is the same. We're buying the same types of companies. We're partnering with the same types of partners. Our day-to-day of sourcing deals and doing the integration and operations with the companies are exactly the same. Right? Maybe the only difference now is doing more of these deals and more follow-on acquisitions and integrating a little bit faster than maybe we'd done historically. But we were on that trajectory anyways. So whether we're doing that out of an independent sponsor or model or a fund model, it really is identical. And I think the only change that's happened to our day-to-day life is there's less fundraising now, right? I think one of the biggest trends is in the independent sponsor model, at the pace we were doing deals, we were probably going back to investors every 3 to 4 months with either a new platform or a follow-on deal on a platform where we had no more committed capital to go get that deal done. And that's really tough. It's distracting. It's really hard when you have a live deal that you need to close in a few months and you're spending, a big portion of your time going and having meetings and calls with all the investor base, which with our independent sponsor model was a pretty long list of investors. And we saw a lot of value in, hey, let's just do one time, maybe take 3 or 4 months to raise that larger fund amount, but then we don't have to do any other fundraising after that. But, I really consider ourselves still to be business builders, in this fund model. And it's really no different. I agree with you. The deals are crossed, but I think that's fair for LPs in either of the models. We had the same LP base across all of our independent sponsor models, independent sponsor deals. So we think it's pretty fair that some of these deals should be crossed. And I think there's just upside in the fund that we have, a bigger trajectory of going out and doing more and more deals and raising more funds out there. And it wasn't an obvious decision. We totally agree. There's definitely benefits of an independent sponsor model, but for us at our stage, we felt that the pace that we wanted to go buy companies at and build businesses was a better fit for that fund model.
And Nicholas, I think all the attributes you described that pertain to the independent sponsor model are very entrepreneurial, right? And I think because we're not private equity guys, we do not consider ourselves as private equity guys. We consider ourselves as entrepreneurs that are very operations focused. It was tough for us to make that departure to a more traditional fund route. And I think the downside of our current structure is that we'll probably have to spend more time describing to business owners that we're not traditional private equity. We haven't lost focus of that entrepreneurial mindset and that operations first model, which has made us successful today. And I think that will be the biggest challenge for us, is to continue to not lose sight, nor to lose our DNA, which is that entrepreneurial model that led us to become independent sponsors. With regards to the reasons for doing the fund, in addition to the ability to go faster and our team, there's also this unique time frame that we have to put baby boomers into retirement, right? Depending on who you ask, the average business owner in the US is 55 to 60 years old. Depending on who you ask, there are 500,000 to a couple million businesses that have between 20 and 200 employees, and that is the heritage holding opportunity. It is to help baby boomers find that solution, that path into retirement, while rolling in some equity with a firm that is very focused on making that equity valuable a few years down the road. That is our part in the PE life cycle, if you like. Going from a more risky business dependent on one or two people to professionalizing those businesses, getting them to scale, and then passing them on to larger, more sophisticated buyers. It's a multi-trillion-dollar opportunity. Again, I don't know whose numbers to trust, but the number $10 trillion, gets thrown around in terms of the assets tied up in small business that need to be transferred to the next generation.
But is this the right answer for any independent sponsor who has scaled and is ambitious? Or, because you made it, right? You have 7 platforms. You have 7 diversified revenue streams of management fees coming in. I know you exited some of them, so it wasn't all overlapping 7 at the time.
But we're at 4 today. But yeah, we went up to 5 in 2021, and the goal is to do 5 through this fund. So point is taken. I don't think that's necessarily the right path for everybody. I think Ross and I are both very ambitious people. We're competitive. We like to win, and part of it is scaling our model to touch more businesses, to touch more business owners, and growth is inherent to that. And so we'll continue to be opportunistic about finding ways to grow in terms of the size of Heritage Holding, the number of acquisitions we'll make over time.
Alex, like me, you are European based in the US. Well, right now you're actually at a log cabin or a chalet in Switzerland recording, but in general you're based in the US. And so
That's right.
Why are you doing deal by deal private equity in the US and not in Europe? And what are the differences?
Yeah, that's a great question and something I've thought a lot about. I think the primary reason was the opportunity to work with Ross. I definitely found my the right business partner in Ross Porter, and as Ross mentioned earlier, we balanced each other out super well, and I felt that the opportunity to partner with Ross was worth making my life in the U.S. and building my career here because of my gut feeling towards that partnership. The other big reason is that the U.S. remains a country of entrepreneurship. This is a country where investors take risk, lenders take risk. It's much harder to get a non-personally guaranteed loan, and in some countries, like my own country, having had some conversation with some private bankers, I sort of almost got laughed out of the room and was asked who my father was, kind of thing, right? It's not the same as when Ross and I had a business that had 85% customer concentration. We walked down the street to Cambridge Savings Bank and found a lender that believed in us and believed in our thesis and lent us $10 million to do the acquisition. And so, it's just the entrepreneurial mindset of this country is an enormous strength and something that I really believe in. I sincerely believe that in the U.S., if your first few ventures don't go well, you're the guy that tried. You're not necessarily the guy that failed. And in some some older Western economies, that might not be the case. So it felt like the right place to build my entrepreneurial career.
I echo that for sure. I think Alex and I will both say that the best part of our job, and we're big fans of being, having fun while we're working here, is just meeting with these business owners. I think there's nothing more exciting than us than sitting down with a new business owner, learning their path of how they started the business, what they took on as risk along the way, and how they built it to where they're at. And it's fascinating. There's just so many different ways that you can be successful in these small businesses. Some drive through operations, some through sales and growth, some just have some weird niche business that they cultivated over the years. But it's really one of our favorite parts is meeting new business owners, sitting with them, and understanding how they made such a successful thing, and then us trying to figure out how do we keep it successful and keep building it. But
every business owner has their own secret sauce, and we get to learn that secret sauce every day from different business owners. It's just the best education we could possibly have every day.
Well, gentlemen, congratulations on all of your success. It's a wonderful story. I love how you've kind of marched up through the tiers of of really lower middle market private equity, starting all the way as searchers and now as private equity proper, but still in the lower middle market. And it seems to all have happened very organically without some master plan. A pretty interesting feature of your story, I think. If people want to reach out to you, do you like LinkedIn? Is there some better way? Should we send them to Heritage Holding? What do you like?
Shoot us an email, alex@heritage-holding.com. We'll try to answer as best we can. And thank you, Will. Thank you, Nicholas, for having us. This was a great conversation. Enjoyed it a lot.
Thank you both. It was great to talk about the story.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.